Eton challenges, generations, retail presence, and financial strength. When we study a company that has survived nearly 100 years, we must look beyond products. We must study leadership, resilience, and financial discipline. Eton is not just a fashion brand, it is a fourth generation family enterprise that has adapted to wars, recessions, globalization, and digital disruption. The company was founded in 1928 by David and Annie Peterson in Gunghester near Borås. The first generation built the foundation of craftsmanship. The second generation, led by Gustav Peterson, strengthened production and Scandinavian expansion. Now let us clearly mention the third generation. The third generation included family leaders such as John Patterson and other members of the Patterson family who gradually transitioned the company from a strong Nordic manufacturer into a global premium shirt brand during the late 20th century. This generation understood that competing only in Sweden would limit growth. They invested in international distribution, branding, and high quality fabric sourcing. During their leadership, Eton introduced advanced wrinkle-free technology, premium Egyptian cotton sourcing, and sharper tailoring standards. They moved the company into high-end department stores in Europe and later the United States. This period saw significant growth in export revenue. International sales began forming a major share of total turnover. Today, the fourth generation, including Sebastian Peterson, continues leadership with a modern global mindset. They have expanded into more than 50 markets worldwide and strengthened digital presence through e-commerce platforms. Now let us talk specifically about Boros. Although Eton operates globally, Borås remains symbolically important because it is Sweden's textile capital. Eton does not operate a large number of standalone retail stores in Borås itself. Instead, its products are available through selected premium retailers and fashion outlets in the region. Borås is more important as a historical and textile ecosystem base rather than as a large retail concentration. Major standalone flagship stores are located in international fashion cities rather than concentrated in Borås. Over 100 years, Eton faced many serious difficulties. First came the economic instability of the 1930s and the Second World War era. Raw material shortages and limited trade created pressure. The company survived by focusing on domestic markets and controlled production. Second, during the 1970s and 1980s, European textile manufacturing faced heavy competition from low-cost Asian producers. Many Swedish textile companies collapsed. Eton survived because it did not compete on low price. It positioned itself in the premium segment. Instead of mass production, it focused on quality differentiation. Third, globalization in the 1990s brought intense competition from Italian luxury brands. Eton responded by strengthening its identity as a specialist in shirts only. It did not dilute its brand by expanding into too many product categories. Fourth, the financial crisis of 2008 affected global luxury consumption. Retailers reduced orders. Eton survived by maintaining strong relationships with premium department stores and by managing inventory conservatively. Fifth, the COVID-19 pandemic severely impacted formal wear demand worldwide. With offices closed and remote work rising, shirt sales declined temporarily. The company adapted by strengthening online sales channels and adjusting production volumes carefully to protect cash flow. Now let us talk about financial health. As a privately owned Swedish company, Eton does not publish extremely detailed global public reports like listed corporations. However, available financial summaries over recent years show stable revenue in the range of several hundred million Swedish kronor annually. The company employs several hundred people globally. What indicates strong financial health? First, it remains family owned after nearly a century. That suggests controlled debt levels and sustainable profit margins. Second, it has continued international expansion rather than contraction. Third, it invests in innovation and maintains premium pricing power, which indicates healthy gross margins. Fourth, it survived multiple economic crises without bankruptcy, acquisition, or forced restructuring. If we had full access to their detailed balance sheet, we would examine revenue growth trends, operating margins, debt to equity ratio, cash reserves, and inventory turnover. But based on longevity, international presence, and continued premium positioning, the company appears financially stable and strategically disciplined. The real strength of Eton is not rapid expansion, it is measured expansion. It did not grow by opening hundreds of risky stores, it grew through partnerships, brand reputation, fabric innovation, and generational continuity. From a small Swedish workshop in 1928 to a globally respected premium menswear brand today, Eton's story proves that specialization, disciplined finance, and generational leadership can build a century long legacy. In our next video, we can analyze Eton's competitive positioning against Italian luxury shirt brands and discuss its future opportunities in Asia and North America.